Well, emerging market analyst for Nomura, Attard Montalto, is based in London. We asked him what is holding South Africa back. He says global investors are still interested, but they're not in love with South Africa as an investment destination at the moment.
There's still a degree of compensation, if you like, for the structural picture, for the weak growth picture in South Africa. So hence money is still sticking in with South Africa on the portfolio side. But it's not a love affair. People aren't saying I'm buying South African bonds because, I think there's going to be loads of jobs created and, very healthy economy. FDI is slightly different. There is FDI going on, but it's mainly brownfield FDI. Things like BMW recently announced another car model will be produced, but in an existing factory. The amount of pure greenfield job-creating FDI is actually exceptionally low in the economy. There are sort of famous headlines like Apple recently came here, but if you look at what happened there, they set up a service office. A few very highly paid individuals living in Sandton. This isn't your mass creation of jobs and manufacturing jobs, blue-collar jobs, which is what the country really needs.
And is there a lack of confidence? Today it came out that South African firms sitting on about 600 billion, I think it is, rand that could be invested. So if we're not investing in our own economy, is that another signal to global investors?
Well, exactly. The two key figures around that are the lack of private sector investment that's going on in the economy. We'll see that coming out when the SABC delivers their growth numbers in 3 or 4 weeks' time. And that's at sort of exceptionally low levels of basically flatlining in the last couple of quarters. That shows that the domestic population is investing onshore. And then the counterweight to that the SABC also produces is the FDI offshore investment data, where we see net negative FDI. That means money's flowing out of the country. More companies, South African companies are investing abroad than foreign companies are investing in South Africa. And again, that's really a signal about the lack of sort of policy certainty, the lack of vibrant economy. The cash situation that you mentioned is interesting. If you look at it versus GDP versus the cycle that we're in, it's not massively out of whack, and that's because people are investing offshore. There is a certain amount of money that is being put to use. So it's often a very political comment that people make around this pot of cash should be invested, it should be going to create jobs. But actually it's more important, I think, to look at the fact that the cash is flowing offshore to opportunities, particularly in the rest of Africa.
Rather than coming here. You mentioned policy uncertainty, and this is something that investors harp on continually. What is expected of government? Where does the uncertainty lie?
Well, I think it's mainly a trust issue. If you actually sort of nail down within, for instance, the Investment Promotion and Protection Bill, there's nothing dramatically sort of off, kilter about where investors actually want that piece of legislation. The whole issue around, for instance, the Investment Promotion and Protection Bill is the trust issue, where foreign investors, particularly mainland Europe investors and US investors, are seeing the cancellation of bilateral investment treaties. They're seeing the opportunity potentially for government to open up expropriation in the future. All these sorts of questions start coming up. So it's more a question of trust on things like that bill specifically, as opposed to the line by line of what the legislation is actually saying. But more generally, there's uncertainty, for instance, regardless of what sector you're looking to invest in. If you look at, for instance, the securities bill around the private security industry, that's a piece of legislation that is against WTO rules, that is sitting on the president's desk now for about a year, where even if you're not investing in that sector, investors are looking at that, looking at the requirements for more than 50% ownership. We've had, obviously, from the NGC recently talk about that in the farming sector as well. People have in the back of their minds, will that happen in my sector? Will it happen in the car sector, for instance? And that's where the uncertainty comes from.
And like you say, it takes more than a year to get a decision. So you want decisions made quickly.
Exactly. And ultimately, what the message I always give government is, we kind of don't mind what you do, as long as you do it quickly, you do it efficiently, you do it transparently. We can work with that. Obviously, we would hope there would be free market policies and structural reforms, but as long as the government is transparent and doing things efficiently, regardless of where the policy actually is, that's the first step, at least, for foreign investors to gain confidence, and local investors as well.
Let's look at some of the other things you've raised. Fiscal policy and the fees must fall. The protest this year highlighted for everybody that we have this pie. It has to be split up. From an investment perspective, is the money that we have going to the right places?
Well, there are two issues here. There's allocation, which is about going to the right places, where I think there's still a huge amount of slack within the budget is going, for instance, to feeding programs in schools where 3/4 of it disappears before it actually reaches schools, around the rent extraction that goes on in procurement, the 32 billion rand that can be saved, the Treasury's identified through government procurement. There are those sorts of things which can be cut, but which probably are politically unfeasible to cut. This rent extraction is part of a larger economic model in South Africa, if you like, that sort of oils the wheels of how the political economy works here. Whereas the actual amount of money, the overall size of the pie, is now the more pressing issue, particularly for foreign investors. There is no money left that's politically feasible to cut.
I'm concerned about what you're saying, that investors are accepting corruption, basically.
Well, I mean, it's always the price to pay that there are deadweight losses within budgets to come. And I think investors don't accept it as a good thing. They accept what is politically feasible to cut within the budget. And for the first time in almost 10 years, probably, fiscal policy is now a real issue for foreign investors. The Treasury was recently road-showing throughout Europe and in New York. They got some very stark feedback, which I don't think they've got in the past 10 years, talking about investor fears around where the budget goes from here, the fact that there's no slack, really politically available slack left to cut in the eyes of investors, that the next moves have to be tax hikes if the government wants to undertake additional policy, the political infeasibility to do that at the budget next year with the local elections coming up. Fiscal is in a very different place now, and that, of course, then links in with the whole rating questions.